I'm here at the Blockworks Digital Asset Summit here in New York with Brent Johnson. Brent and I were just on a panel with Adam Back and Teddy Valley talking about the future of Bitcoin and the dollar. It is a digital asset summit, so the panel was mostly focused on Bitcoin, but Brent has been absolutely nailing it on the dollar, showing extreme strength against the euro, the yen, pretty much every currency under the sun. So I wanted to get some time, just me and Brent, to talk pure macro. Here is the conversation I had with Brent Johnson. Brent, great to talk to you.
Happy to be here.
We just got off the panel talking all about Bitcoin and Bitcoin versus dollar, who's going to win. In this conversation, I got you, off stage. I just want to ask you purely on the fiat side, on the macro side. So Brent, the dollar, which you've been very bullish on for sort of structural reasons, has been on a tear this year. Could you elaborate on why you think the dollar has been so strong, particularly against like the euro and the yen?
Yeah, I mean, essentially it comes down to supply and demand. I know a lot of people have been expecting the dollar to fall based on all the new supply that's been issued by the Fed over the last few years. But what needs to be remembered is that fiat currencies trade relative to each other. And despite the massive increase in supply by the Fed, they're printing, quote unquote, for the whole world because the whole world uses the dollar. Whereas when the ECB prints, they're mainly printing for Europe. When Japan prints, they're mainly printing for Japan. And when you look at the amount that the Fed has issued compared to the global monetary base, and you measure that against what Japan has printed versus the Japanese monetary base and the European central bank monetary base, the Fed is behind those two. And those two currencies are continuing to do it. The Fed has been aggressively raising rates. The ECB has now started to raise rates, but they're behind the Fed. Japan has not raised rates. And so you've seen a massive move in these two currencies. For major currencies to move the amount that the euro has moved this year is a big deal. To move the amount that the yen has moved this year it's literally unheard of.
Yeah.
A 20% move in the second or third biggest currency in the world is, without literal intervention making it happen, it's really unheard of. And so I actually think it is by design. And I think the Fed agreed to it. I think the Bank of Japan said we're doing it and got the Fed's blessing. And so I think otherwise there would have been some comments out of official circles. And they would have been labeled a currency manipulator or something to that effect. And to be honest, I don't think this is going to change. Japan can't really change. They don't have the option to change. And I would bring it back to the arguments that a lot of people make on the dollar. I think that in many ways, people make accurate analysis on the dollar. The problem is they don't do the same accurate analysis on all these other currencies, right? And all the issues that people put forth for the eventual demise of the dollar, which I agree will eventually happen, are already happening today in both Europe and Japan. And you're seeing it in the price of the euro and the yen.
And so there's money printing, quantitative easing, which is the central bank prints money and then buys assets from normally commercial banks. And so the Fed did a lot of quantitative easing in 2020, 2021, and now it's quantitative tightening so that the money supply reserves are actually going down. So that's the sort of quantity of money or the composition of money. There's also the price level of money, as you said. Sure. ECB and the Bank of Japan have been very slow to raise interest rates, particularly the Bank of Japan, extremely slow. While the Federal Reserve is sort of ahead of the curve. It was behind, but it was less behind than Europe and Japan. I think that's the reason, when people say, why do currencies move? There's so many different factors.
Sure.
But one of the reasons that they move, and it's the reason that I can most easily wrap my head around, is interest rate differentials. When if the Federal Reserve is yielding 4% and the European Central Bank is yielding 1%, money is going to flow into the dollar. So how big of a factor do you think that interest rate differential has been?
Oh, it's been huge. No question about it. Again, there's an automatic bid for the dollar just because of all the global debt that's issued in dollars, the trade that takes place in dollars. So there's a natural bid for the dollar. But when interest rates differentials favor the U.S., it just adds an additional layer of demand. And so no question that has played a role. You saw the dollar made a big move in the first 6 months. In July, the ECB finally raised rates for the first time in 10 years. And the dollar pulled back a little bit. And then it got stronger again. And then ECB raised rates again last week. And so the dollar pulled back a little bit. But now, today, the dollar's up again. So you can see those interest rate differentials playing a role. And I think this would be a natural time for the dollar to pull back.
Mhm.
I mean, it's had a heck of a run. If it got up to 110, if it went back to 105, 104, 103, that wouldn't shock me at all. What I kind of find humorous is every day that it does tick down, people are like, see, that was it. See, that was it. See, that was it. But, until something fundamentally changes with the design of the monetary system, this underlying bid for the dollar is always going to exist. So if the Fed came back, if they started lowering rates, went back to QE, went to easy monetary policy, while Japan or ECB or whoever it is starts to do relatively tighter monetary policy, the dollar could go back to 90 to 95. But I think if that happens a year or 2 years from now, we're right back to where we are now, just the same way that after COVID, before COVID or at the initial stages of COVID, the dollar went to 101. They came out, the Fed did QE, easy monetary policy, it went to 90. And everybody said that was it. Well, here we are, 20% higher. It wasn't it, right? Because nothing fundamentally changed with the design of the system. And I guess that's really the basis of my whole argument is until they change the design of the system, this underlying bid for the dollar is going to exist, despite all the arguments to the contrary.
How high do you think short-term interest rates will have to go before central banks, let's say the Federal Reserve in this case, will be satisfied that it will be enough to tame inflation? At first the number was 1.5, then it was 2, then 2.5, then 3. Now it's 4.3% is what's priced into, I think, April Fed funds futures for 2023. Yeah. So, when does this madness end?
Well, I'm going to give you an answer. The only thing I don't like about the answer is everybody tends to agree with this answer. Yeah. And so I always hate having the same answer as everybody else because it scares me because everybody's usually wrong then. But, I think that they raise until something breaks. Yeah. Part of the reason I think, to a certain extent, the Fed is embarrassed. They got it wrong. They thought that inflation was lower than it was. And they really cannot afford to be wrong again, right? So if they were to stop hiking now, or God forbid, even cut rates, and for whatever reason, whether you believe it can happen or not, but for whatever reason, inflation ticks higher, then they would really be crucified. So they really can't afford to stop now, especially after they've, said over and over and over again, inflation's our number one goal. So my guess is they'll keep hiking until they crush demand. That will have an effect on inflation. I don't know if it'll work to the same extent that they think it will work because I think some of the inflation, actually I think a lot of the inflation is supply driven as opposed to just demand driven. But that's what I expect to happen. I expect them to keep hiking. They even came out and said, after the July raise, and it was perceived as somewhat dovish, and equity and risk assets rallied, and then they came out and they said, we don't necessarily think the market's reacting the way it should. And Kashkari and a couple others came out and said that we're going to have to, demand's going to have to fall, and we have the tools to do it. So I think it would be very hard to think that they are now just going to pivot out of the blue. They will pivot eventually, but they'll pivot when asset prices are a lot lower and they have to pivot. I always say the Fed is a reactionary agency. They're not a proactive agency. They're always behind the curve, in my opinion. Yeah. And when markets crash and they have to come in and save it, then they'll pivot. Yeah.
So Brent, that is short-term interest rates, which are largely controlled by the Federal Reserve. What about longer-term interest rates, like the 10-year Treasury note, the 30-year Treasury note? I know a lot of the reason why the dollar has been strong, despite the fact that that the U.S. persistently runs a trade deficit, is that, let's say, China exports a lot and has a lot of dollars, and then they buy treasuries with that. How important is that recycling system? And do you think that there's a risk that folks will stop buying treasuries?
So I would never say it's not important. Yeah. And I agree that China and to a certain extent Japan have stopped buying the long-term ones, and they've started selling them in some cases. Russia's very famously sold all their treasuries. It's not that it's not important, but again, it comes back to the relative issue. It's possible that there's a buyer's strike on U.S. treasuries, but I do not think that we are going to get into a situation where the U.S. government cannot fund itself, but the British government can fund themselves, or that the ECB or Germany can fund themselves and France can fund themselves. So if we get into a situation where the treasuries are not being bought and interest rates are going higher, I think we have a sovereign debt crisis. And that's actually where I think we're headed. But I think once that sovereign debt crisis kicks off, I think institutions, entities around the world will buy treasuries before they will buy Japanese government bonds or Chinese government bonds or British government bonds. So I'm not saying that it's not possible, but it's not a huge concern of mine, because I think in that scenario, well, the reality is we're hedged for that scenario.
Yeah.
So we're kind of expecting this scenario to happen. It wouldn't surprise me in that scenario if people rush to treasuries. Treasury yields could fall and prices could rise. I really don't know. I'm not playing the long treasury market as a trade itself, but I am playing the sovereign debt crisis as a trade, because I think that is definitely on tap.
Okay. Without sort of going too deep into positions that you have at Santiago Capital, are you looking at like credit default swaps on the sovereigns? Are you sort of shorting them?
Well, we're mainly doing it through currencies.
Okay.
And then because we think that will be the outlet. We're not necessarily shorting the bond. The bonds are a little tricky. I'm not saying it can't be done, but so far we haven't done the bonds just because we're not there yet. And the central bank in Europe, the central bank continues to buy them.
Yeah, right.
In Japan, they continue to buy them. Maybe when it kicks off and we see an opportunity, perhaps we'll do it that way. But we think the outlet's going to be the currency. So that's the main way. But then we're also playing kind of the second and third knock-on effects of these currencies going down. We think there's a number of economies around the world that will be in a lot of trouble when that happens, specifically Australia, specifically Canada, China, Turkey. These are just a few. There's a lot of everybody. And when I say this, the U.S. could be in trouble as well. Just less trouble. And so we think that on a relative basis, global capital will flow to the U.S. and the U.S. dollar versus the rest of the world. And I know people have heard me say this before, and they'll say, you've been saying this forever. Well, the truth is it's been true forever. If you look at the U.S. stock market versus the rest of the world over the last 3 years, the U.S. has outperformed. If you look at the U.S. dollar versus other currencies over the last 3 years, the dollar's outperformed. Dollar assets in U.S. markets have outperformed the rest of the world for 3 or 4 years now. Global capital has flowed to the United States for the last 3 or 4 years now. I think that will continue.
When you say you see trouble ahead for sovereign markets, Canada, Australia, Turkey, China, how much of that is due to a theory you call the dollar milkshake? And to what degree is that different than, the ECB is hiking less than the Fed?
Yeah, well, it's all really related. And I think that's the important thing to understand, especially with macro. Like if you're analyzing Tesla versus Coca-Cola, maybe they're not interconnected.
Yeah.
But when you're analyzing Japan and Europe and the United States and China, they're all interconnected because they're all kind of relative to each other. The dollar milkshake theory is basically my thesis that the dollar will go higher because we will enter the sovereign debt crisis. And as a result, they'll have all these knock-on effects around the world. Other currencies will get printed to a greater degree than the US dollar, which creates a knock-on effect where the dollar goes higher and these other currencies go lower. As that happens, we think that China becomes in a lot of trouble. We think they will probably have to weaken the yuan. We think the Hong Kong dollar peg will break. When that happens, we think Chinese growth will fall significantly. China buys a lot of commodities from both Australia and Canada. If Canadian revenue starts to go down because China is no longer buying all these commodities, that hurts Canada and Australia. If interest rates start to rise because we have this sovereign debt crisis or because central banks have to raise rates to fight inflation, that hurts the real estate markets in Canada and Australia. And so, this is what, and as the dollar goes higher, it puts pressure on everybody. Mm-hmm. And so this is what I mean, it's all kind of related. There's a number of different ways to play this. But it is all related. And so, the dollar milkshake theory is really more than anything. It's not just the dollar going higher. It's really a framework for how I see a sovereign debt crisis playing out. And it's not that I think that the United States is immune to that crisis. I think we will get hit, but I just think we will get hit last. We will be the last domino to fall, so to speak.
Mm-hmm. For a sovereign debt crisis, is it essentially impossible for there to be a sovereign debt crisis if the sovereign owes money only in its own currency? I'll give an example. The U.S. owes a lot of money, but it's in dollars. The U.S. can print dollars. Thailand in 1997 owed a lot of money that was denominated in dollars. It could print Thai baht, but it could not print dollars. So it had to print more and more Thai baht, and then there was a huge devaluation. So is it possible for a monetary sovereign that owes its own currency to have a sovereign debt crisis?
I wouldn't say it's impossible, but I don't think it can be the first one to go. And that's why I say there will be a progression. I think it starts in the periphery and it works its way towards the core. So I think we could get into a situation where all sovereigns are printing like crazy. and other currencies, periphery countries, starts to go through hyperinflation or very high levels. I hate using the term hyperinflation because I think it's way overused, but you could see very high levels of inflation
20, 30, 40%,
exactly, on the periphery. And you could, this is the really important point that I'm glad we're talking about this, because you can have inflation with a rising dollar. I mean, if this year hasn't proven that, I'm not sure what I can do to prove it to you. So this idea that the dollar has to fall because we're going to have inflation is just not correct. So we could have a continuation of what we're already seeing this year, where the dollar continues to go higher, we continue to have inflation, and the rest of the world sees inflation in their local currency terms, but deflation in US dollar terms. And see, this is the worst of all worlds. This is essentially what the milkshake is when you get inflation in local currency terms and deflation in US dollar terms. And they're getting squeezed from both ends. Other countries, their revenue's falling because global growth is slowing, but their input costs are going up because the dollar is going up. And it really just puts them in a really, really bad spot.
Right.
The other thing I would say is, it's possible we go into deflation too. I've often gotten labeled a deflationist because typically when the dollar goes higher, that does create deflation. I really don't care whether we have inflation or deflation. I don't really care how I'm labeled. Well, what I do think is we're going to have a crisis. I don't think there's any way out of the crisis. I think that the dice has already been thrown, right? It's just a matter of how they land and at what time they stop. But whether it's an inflation or a deflation, or whether I get labeled with an inflation or a deflation brush, it doesn't really matter. The point is that fiat currencies are losing value. But the difference is that when the Australian dollar goes up versus the South African rand, it's not necessarily that big of a deal. Right. But when the US dollar goes up versus the Australian dollar, when the US dollar goes up versus the yen or the yuan, that's a big deal because everything's priced in dollars. So if the denominator is rising, prices tend to fall. Now they don't have to fall, but they tend to fall. And so you can get into even though we're in an inflationary environment, we can have bouts or short-term deflationary shocks to the system. And so, I'm kind of prepared for either inflation or deflation. I think we're probably going to have a little bit of both. But ultimately, I think this ends up in a currency crisis.
Yeah, so the Australian mining company spends Australian dollars to produce copper. That copper is sold in dollars. Right. So the dollar getting stronger against the Australian dollar would be quite... That wouldn't that be good?
That would actually help them, but if the problem becomes if they're no longer able to sell the copper because China no longer buys it because China's in a recession.
Mm-hmm. Yeah. Right. Okay.
Right.
So a typical sort of sovereign crisis. Thailand, 1997, Argentina, where there's a bunch of debt that's not denominated in your own currency, and you have a huge deficit, all types of deficits. That's pretty easy for me to wrap my head around about why that's a recipe for disaster. But explain to me why you think the Chinese yuan will encounter trouble. Interestingly, Chinese yuan, I believe, not in the US dollar index, DXY, which is what you're referring to when you said it went to 110 and 88. Because there are a lot of folks who say the yuan, Chinese yuan, also called the renminbi, RMB, is very undervalued because it has such a huge trade surplus and it has these ample trillions of dollars of FX reserves. So what's your outlook on there? And then I also have seen some folks talk about how the Chinese FX reserves are actually shrinking.
Yeah, so I do not believe that the yuan is undervalued. I think it's dramatically overvalued. I think if it was allowed to float freely, it would decrease in value a great deal. I think to a certain extent, the yuan is a managed currency. It's not totally pegged anymore, but it is still managed. There's a currency board that makes sure it stays within a band. They have a lot of deflationary pressure in their economy because of the real estate market has started to crash. They also have high inflationary pressures because they import energy and food, right? And those are imported in dollars. And now that the U.S. is raising rates, the dollar is getting stronger versus the yuan. So they're getting squeezed from both sides. Revenue's down, costs are up. Profit margin is getting squeezed. In that scenario, I don't see how the yuan is undervalued. I think to counteract the deflationary pressures that they're feeling in the real estate market, I think they will eventually have to write off those bad debts and let the currency float and not let that be the release valve. When that happens, the reason they would devalue their currency is to pull inflationary pressures into China to counteract the deflationary pressure of the real estate market. So if they're pulling inflation in, they're sending deflation out. So they would be trying to export their deflation of their real estate market to the rest of the world. If that happens, then the dollar gaps up, and then that puts pressure on the rest of the world. So this is what I'm saying. We're in an inflationary environment, but there's a number of factors out there that could lead us to have a very deflationary spike. And maybe it only lasts a week, maybe it lasts a couple months, but I don't believe that just because we're in a highly inflationary environment, you can totally write off the possibility of a deflationary spike.
Yeah, and certainly the U.S. is extremely well supplied as a huge supplier of food and energy, unlike Europe, unlike China, unlike Japan.
Yeah.
We talk about the dollar system that's really existed since 1945, since Bretton Woods, but it's changed. 1971, the dollar went off the gold standard. The euro-dollar system, offshore dollar system, became a lot bigger. Volcker raised interest rates to an extreme level to tame inflation. And then we still call it the dollar, but then after 2008, 2009, the plumbing of the system changed. The Federal Reserve, the liabilities that they have in circulation is just huge. Sort of what banks call money now used to be like pretty much exclusively treasuries, and the reserves were kind of these chips that they exchange back and forth when they wanted to do business. But now it's they have over $2 trillion reserves in the system. So the dollar, even though my point is, even though we call it the dollar system since 1945, it's gone through so many different changes. What do you think is the next way that the dollar system will evolve? A lot of people talk about stable coins. I don't know if you're going there, but how do you see it playing out?
Well, ultimately, what I think is going to happen is that this currency crisis that I've spoken about will cause some kind of an event where the system gets reset. Now, whether they write off sovereign debt in that environment, or whether they come up with a new currency system like a new Bretton Woods, I really don't know. I think something's going to be forced on the governments of the world. What I think will come next is some sort of government-sponsored stablecoin, whether it's Fed coin or what do they call it, the coin now or something. I know they announced it a month ago. I don't remember the exact name, but I think the genie's kind of out of the bottle with the stable coins and with the Bitcoin and the rise of crypto. I think that the governments of the world are going to adopt what was created in the private market and use. I don't think we're going to go to a Bitcoin standard. I don't think Bitcoin's going to become money. I think governments are going to kind of co-opt that digital asset space for their own. It doesn't mean that digital assets won't still exist and be a store of value or trade as a reserve asset in some form or another. But I do think that we're going, I expect us to continue to have a fiat system. It would be the first time kind of in the history of the world, not totally, but to a certain extent that no government was overseeing the money, right? And it was just a total free market for money. I think that's very highly unlikely. I know kind of within the crypto world and within the digital asset space, DeFi is kind of an important thing. I actually think that the world, this is not what I want, but it's what I see. I think we're going towards a more centralized world rather than a decentralized world. I think power is being consolidated rather than given away. And I think when we get into this sovereign debt crisis, you're going to see even more power consolidated. And when that happens, I do not expect whoever wins that battle, I don't expect them to cede power over the currency to somebody else, or certainly not a private market currency.
Right. And so now I have an account at Bank of America. Bank of America has an account with the Fed. The move to a central bank digital currency would allow me to have an account with the Fed. Do you think that the commercial banks sort of get cut off on the action? And what do you think? The commercial bank system is extremely important when people talk about printing money. So do you see how JP Morgan, how do these big banks thrive in an environment where everyday people can just interact with the Federal Reserve?
Well, so this is an area that I've thought a lot about, and I kind of find it really interesting. I haven't come to any conclusions yet, but I think there's a potential battle between the Treasury and the Fed, which sounds impossible because they work so closely together. But if you think about it, the Fed kind of represents the banks.
All right. Had a fantastic interview with Brent. We just were starting to talk about central bank digital currencies and stuff, but there's a fire alarm, so we're going to have to end it there. Brent, thank you so much.
Good to talk to you.
Yeah, good to talk to you. As you noticed, an alarm went off in the middle of our conversation, so unfortunately, Brent and our chat had to be cut short. Sometimes that's just how life is, but I hope you enjoyed what you got to listen. Thank you for watching.